Thanks for joining us for our Fall 2017 Crop Outlook webinar. I'm Jim Mintert, Professor of Ag Economics and Director of the Center for Commercial Agriculture. And joining me today on our webinar is Chris Hurd, who's a Professor of Ag Economics and an Extension Ag Economist here at Purdue. We're going to talk a little bit about some of the things that are driving changes in corn and soybean prices. Yesterday, USDA released the Crop Production Report and their most recent set of world ag supply demand estimates. We'll review that and talk a little bit about the implications and what it means for the outlook. And so, Chris, let's go ahead and get started. You've got a chart here looking at ending stocks or projected ending stocks for the U.S. And why don't you walk us through that a little bit?
Yeah, and I think where we want to start out here, Jim, is to say that inventories are high and that what we should be thinking about in terms of price objectives is probably fairly modest gains in terms of prices. And you'll hear that mentioned several times over. When we look at the U.S. stocks, obviously the green line up there at the top, that's wheat. We have nearly a half a year's supply of wheat, huge burdensome supplies of wheat. The blue line is the corn carryout as a percent of a year's use. We've been 5 years where we've been increasing inventories. We're at 11-year highs in terms of inventories measured this way. The red line at the bottom is soybeans. Again, 4 years we've been increasing our inventories on soybeans, and those are at 10 years highs. We'd have to go back a decade to see inventories higher than that. So again, I think we want to start with this message of saying inventories are high. Keep your upside price objectives fairly modest. There's nothing wrong with hoping for a big gain, which could happen if we have a major weather disruption. But for a lot of our production this year, I think we should be thinking more modestly. We can turn to world numbers and see a little bit of change. And one of the things I like to talk about when I'm doing Outlook is there any hope for any improvement? And I think when we look at the world picture, we do see some hope on soybeans and corn. Wheat is up there at the top line, that dashed line. Obviously, world wheat inventories continue to grow and are expected to continue to grow on into the 17-18 crop. As we look at soybeans, on the other hand, we do see that for the 17 crop, we've got the world inventories dropping a little bit. The red line on corn, we see 2 years in a row of dropping. Now, one of the significant parts for the world is that China has been holding the huge corn inventory, and they are beginning now to deal with that to try to stimulate use domestically within the country, and they're bringing that number down. We're going to look all the way on the red line back to the left on these world stocks. And back in the early 2000s is when China also had big inventories. They began working those off in 2002, 2003, 2004, setting us up then for really tight world inventories that we got into in 2008, 9, 10, and 11. So I think we see a little bit of positive news there. And the positive news is both soybean and corn inventories in the world beginning to come down a little bit. And one of the things that brings them down is normal yields. Last year, we had record yields in the United States, and we followed that with huge record yields in South America. You put those right back to back within 6 months, and we really increased the inventory. So if we get back to more normal yields, is what USDA says for this year, more normal yields in South America, we begin to see some improvements.
And Chris, as you look at the chart, that world stocks to use chart you've got on the screen, one of the things that stands out is the difference between the wheat market and what's going on in corn and soybeans. You talked a little bit about some tightening showing up in the world stocks to use ratios on corn and beans. But as you look at the wheat situation, not only do we have a burdensome supply in the U.S. with that approaching a 50% carryover, but we've got large stocks and actually growing stocks in the world.
And obviously, wheat can be raised in a lot of countries. Some countries and some areas can't raise anything but wheat. So wheat is really having trouble getting adjusted. So obviously, especially for the eastern and western corn belt, we have great alternatives to wheat, and I think that's what we're going to continue to see. Probably wheat acreage in the United States probably down again as we continue to specialize more and more on corn and soybeans, and especially in the primary Midwest.
Let's take a look at those yields. You mentioned the yields, and here's the yield chart, Chris, and I think we've been, 4 years in a row with those yields above trend?
Yeah, and again, this is, we wouldn't say unprecedented. We've had years when we've had very good years, multiple years, of good yields. But really go back to 2012 for any major disruption here in the United States. And as we said, last year record yields 174.6 on corn, and this year a little closer to normal. That 170, 171 we thought would be fairly close to normal. USDA did increase that. They were 169.9 up to 171.8 as of yesterday's update. And again, I think that would seem like that probably should be a bit bearish on corn. But I think there were some in the trade thinking that number really could move higher than that. And so we did see corn close with a little bit of strength yesterday. But 2 bushels higher, fairly close to trend yields, getting back to normal. If we see South America closer to normal, that overall is going to give us a little more of a sense that we're turning the corner on these big supplies.
And you make a good point, Chris. USDA increased the yield estimate relative to their forecast a month ago.
That's correct.
But in the intervening period, most of the trade was expecting a bigger increase than what USDA reported, and that was based largely on some of the early yield reports we picked up from farmers, right?
Yeah, in general, on the early yields, what we heard was probably a little better than expected. And so I think that is where the trade was looking. And certainly some thought it was going to be very good yields. And so I think that's why we didn't have a dramatic up market, but at least some up after that report. Look at the production, 14.3 billion bushels. That's fairly close to our usage base. And again, that 15 billion bushel crop last year, that's where we really got into trouble. Our usage base is more back in that mid to lower 14 billion bushel range. So I think the good news on corn is we're not going to increase carryouts. We're producing about in measure with what our usage base is, and that's certainly good. Now, the consequence of that is more beans, so there's where we put our carryovers into more beans because of the big shift to bean acreage here in 2017.
Chris, let's take a little more detailed look at the balance sheet from USDA and do some suggestions about where things are going to wind up.
Well, first let's start with the 16 crop, just to finish that one off. Again, there may be small adjustments, but this is pretty much where we're going to end up. And that is go down to the ending stocks, about 2.3 billion bushels. And when the USDA did their September stocks report, in terms of the survey, they found about 2.3 billion bushels of corn in the country. That was down 55 million bushels. Now again, that's not a large amount, but it is a little bit smaller for the carry-in to the 2017 crop. So the 2017 crop, looking at that column, carry in about the 2.3 billion bushels. And there, the production then, about a 14.3 production. That was about 100 million bushels higher than what USDA had in their September estimate, but again, not as high as I think some people had anticipated. Increased the feeding use, 25 million, increased the non-fuel food, seed, and industrial a little bit. And go to the bottom line, we basically have the carryout staying around at 2.3 billion bushels. Excuse me, USDA with carryout staying not exactly, but very close, 2.3 billion bushels, dropped the price 16 cents below the 16 crop, 320 estimate for a USDA, U.S. average farm price. Again, they don't give the mean of that. We're interpreting that. What they give is that range 280 to 360 a bushel is the range they're giving. The center point of that range would be $3.20. So again, I think we'd have reason to look at last year's crop, the 16 crop, say, well, we averaged 336 a bushel. Same carryovers basically this year. We could be a little bit stronger price. Now, I do want to mention one of the really negatives for this corn crop that we're harvesting here in the fall of 17. That's the exports. And again, you look at exports for the 16 crop, almost 2.3 billion bushels. Huge crop, particularly in Brazil. We're going to really compete with that crop in Brazil this fall as we are shipping and selling corn. And that's the struggle for corn. It's not the feed usage, it's not the ethanol usage, it is the exports. Will those exports, can we get some more exports with the big South American crop? We may be back end loaded if we get a more normal, some reduction, I think, first in acreage in South America, particularly Brazil. More normal yields in Brazil. We may see more activity in our corn exports really coming on into next spring and summer. So I think there's still hope that we could do better than that on exports. But as you look at corn and soybeans have that strong demand base. They've got China, they've got exports really strong. We've got a strong base for soybean meal in terms of the livestock industry. What corn doesn't have, it doesn't have that strong export base. So I think this really takes away some opportunity for rally or recovery in the corn market.
And I think another thing it points out is as we move through the marketing year, one of the things the trade is going to look at pretty closely are those weekly export numbers, right?
Yep.
And track those relative to expectations, track them relative to last year, and look to see if there is some reason for optimism as we head through the course of the marketing year.
I think that's right. And again, this is a big reduction. And that's always a question mark. We do not know exports and the whole demand pace and what the dollar is going to do and all the things that will influence exports. We do know that world economic growth looks really probably the best we have seen since the worldwide recession 08-09. That's a real positive. We've got the dollar that's weakened some this year. If we go back to the first of the year, we've weakened about 6 to 7% on the dollar. So that's reason to be hopeful. But I think it's one thing we'll probably continue to hear throughout the growing year or marketing year, and that is weak demand in terms of corn exports and make corn struggle to rally very much.
Yeah, good point. So Chris, you've taken a look at the seasonality of prices and used that to maybe project where cash prices might head as we move through the course of the marketing year. Let's talk about that because that looks like there's some opportunities out there.
Well, that's right. And again, this is there is the word hypothetical in the title of this slide. And what we're doing is going back and looking at the last 10 marketing years, taking 2000 out. That was the drought year, and we had a very different from normal seasonal pattern that year. So we took 12 out and took the last 10 years, and then we forced for an Indiana price $3.45 a bushel as an average Indiana, is kind of our guess at this point, and then said with that average pattern, what kind of prices might we see by month here in Indiana. And for October harvest month, that gets us down to $3.18 a bushel. Bids I was looking at in central Indiana this morning, probably about $3.25 a bushel. So that feels pretty realistic right at this particular point. And a normal seasonal price pattern gets us up to about $3.75, maybe $3.80 a bushel. Now to me, that feels pretty realistic for this kind of a year, that maybe we could add something in the range of 50, 60 cents to corn prices. We're going to have the big carry out. We're going to probably have weakness on the export side. But I think this is a reasonable guess at what we might think early in the marketing year. And we can track our progress as we go through the marketing year to see if we stay on this pattern. One thing we know when we're projecting the future isn't always exactly like the average of the past. So many things can happen in the market that would increase demand, reduce production around the world, and especially southern hemisphere. So this just is a general tracking of a general expectation, and I think it's reasonable at this point.
And it does, we'll talk more about this later, but it does suggest the potential for some positive storage return.
Well, that's right. And, I think what we would start out talking about is Low $3 corn prices, $3.20, $3.25, $3.30, depending on location around the Midwest, maybe somewhat less as we go out to the further western corn belt. And that, we'd like to see opportunities to market in the higher $3 to maybe pushing around $4 a bushel. That's what we're going to lay out a plan to try to achieve that. That would be the goal, to get us up in that high 3 towards $4 on corn. And I think similar strategy we'll talk about when we get to soybeans. So let's look at some of those years in history, most recent years. What we're looking at here is by week. What were the cash bids? We're going to just look at 2016 at this point, and that's the green line. So that's last year. Our carryouts nationally are about the same. That's saying our inventory situation's about the same. So let's look at what happened to price pattern, green line last year. We saw cash prices in September over towards the left side, early October, down in the 310, 320 range, not too much lower than we are this year. And I'll point out those red dots are so far this year. So a little bit lower price than we are seeing right now at this time, at this location. Last year we went from 310 up to about $3.70 or so per bushel. So there's your at least 50-60 cent recovery in prices. Now the green line, we dipped some in March and April, but then had that spring recovery, got us back to 370 to 380 corn prices. So as we're looking at a fairly similar overall carryout situation, I think looking at last year's price pattern probably makes some sense. If you add 50 to 60 cents to our 325, 330 prices, that's going to get us on up there in the 375, 380, 390, pushing towards $4 mark. So I think we've got a similar year to look at that tells us that's achievable as well.
And one of the drivers of that, of course, has been this change that we've seen take place with respect to the premium of summer 18 futures.
That's right.
Over the nearby futures or over the new crop futures December. You've got a chart here that takes a look at that. That's pretty interesting, Chris, if you look at the change that's taken place in a relatively short span of time.
That's right. So when we have big inventories, markets need to give somebody incentive to store that crop. And one way futures do that is the more deferred futures prices gain on the nearby futures. So what we're looking at here is the premium of the July 18 corn futures versus this harvest December 17. Now, if we go back to about the middle of the graph, down at the bottom, you'll see where July of 2017 was this summer. And we were about just sort of an average of about 20 cent premium. July corn next summer futures versus harvest time this fall, 20 cent premium. Once we got through some weather scares early on, then that crop really began to look good. The market said we're going to have pretty big inventories, and farmers and other commercial people need to have an incentive to store. So we saw the July futures advance about another 10 cents, up to 30 cent premium over the December futures. So as we're looking at the bids for next summer are based, say June and early July, are based on the July futures. And those are 30 cent premium to current prices that we're using the December futures. The second component we'll talk about, this is the futures carry, and that is basis appreciation. We could add that anticipated appreciation to storage returns, and we'll look at that in a second. But this is pushing out to about 70% of full carry. We generally think in big inventory years we'll get to 70-75% of full carry. So I wouldn't anticipate this carry getting much beyond this 30 cents. There's maybe a penny or two. And if you're storing, you'd like to earn as much of this carry as you can. So here's a big part. Here's the biggest part of where we can earn higher prices for delivery later on. It's because futures markets are giving quite a lot of incentive price-wise for storage on into next spring and summer.
Let's look at this in a little more detail because you've put together a table that kind of helps isolate this a little
Yeah,
more.
and so we're going to put this together in terms of what we'd anticipate cash bids to be. And again, remember cash bids are based off of futures. So we'll look at the futures component first on the first line. This is as of the close yesterday evening, after the report had some time to work through the markets. The December futures were $3.49 a bushel, and the July futures over on the right-hand side were $3.79 a bushel. So a 30-cent premium. That was the spread we were showing you on the last visual. Now again, the basis levels, these are at this particular central Indiana location, are some historic basis levels that I've watched over the years. I'd say these would be my estimates of what bids might be. They're not the actual basis levels that the elevator is bidding right now, but they're ones I think are reasonable numbers to talk about. 25 under at harvest time. So 25 under 349 gives you 324 corn. Let's go to the right-hand side, that 379 futures with an 8-cent under basis, 371 a bushel. So I have the middle of the chart there, the carry. All we're looking at is that anticipated forward cash price minus the harvest price. So for December as an example, 5-cent higher price for December versus November. Let's go all the way to the right, and that's 371 cash versus 324 at harvest. That's a 47-cent premium. Where does it come from? We've got the little summary on the right-hand side. That's the 30-cent higher price in the futures and anticipation of a 17-cent increase in the basis from 25 under to 8 under. There's 47 cents, almost 50 cents a bushel return for storage. Now that's a gross return. The next line, we subtract some cost. 3 cents for November. I put some insurance, and then about a penny a month for on-farm storage. We'll go over to the right-hand side. Cash carry anticipated 47 cents higher prices. Take off 11 cents for on-farm storage. A 36-cent return for our time we put in at our home storage and return for the capital investment in our home storage. Now 36 cents, if a bushel of space cost $1.50, I certainly haven't looked up what that costs, but if it was $1.50, 30 cents of return to storage, that's a 20% return on investment. So these are very good returns for on-farm storage. And this is where we think people need to, once they are ready to price out far enough that they can earn as much of that carry that they get a positive expected return on.
So if you wanted to practice storage hedging, you would simply sell July futures to lock in that spread over the Ds, right?
That's correct.
And then essentially speculate on the basis. That's really what you're talking about.
That's
here,
correct.
right? We're speculating and hoping to take advantage of what that increase in basis
Right.
might be during the course of the storage season.
And if we would check those bids for July, we'd probably see that basis more like 15 under or a little bit weaker, maybe 17 or 18 under. You know, historically, we tend at this location to get 8 under. So that tells me I may be willing to speculate that that basis could come up to more normal 8 under rather than say the 15 under they're bidding right now. If people aren't comfortable with doing that, they could go ahead and sell that July cash price. Then they would be pricing both the futures and have the basis priced as well. But a hedge allows continued speculation, as you say, on the basis. Now let me just finish one more point, and that's down in the shaded section below that. And we're looking at what if you don't have storage? And so a lot of people are obviously in that situation. And so we have a return to on-farm storage going across the months from December, January, February, March. And then I'm going to add commercial storage cost and say that would be an additional cost. And for December as an example, we've got 15 cents flat and then 3 cents a month after December 1st. And that would be 18 cents additional cost for commercial storage. with a 1 penny return. That sounds like a big loss. We look across that bottom row, go out to March and April. Again, what we see is that it looks like our commercial storage space is a little bit more than our expected returns from on-farm storage. And that says that would cost us 2 to 3 cents a bushel to store commercially versus what we think the market will bid us for a storage return. Now, the overall thought on that is to say, well, what if I want to speculate for higher prices? Well, this would suggest it's probably cost you, the market's suggesting, 2 to 3 cents a bushel to speculate that the price won't go up quite as much as what your storage cost is, but that's pretty cheap cost of speculation. So generally the alternatives were this close. Some will choose to go ahead and store commercially. The other alternative is sell out of the field and then come back and, if you want to speculate, buy futures or buy call options. There's going to be some cost to doing that as well. So some people, when these commercial storage costs are in alignment, pretty close alignment with what you expect to return, let's go ahead and store. It's only going to cost me, the market's suggesting, 2 to 3 cents a bushel to do that over what it looks like the market will return. But on-farm storage, it's already there. Really great returns this year, and use all those bushels. The commercial space they find on ground or on asphalt. We'll probably see some farmers find a way to store on a concrete pad or in some neighbors' bins that haven't been used for a few years. These returns, these incentives really do get people to store. That's what the market's telling us. We've got a lot of corn. We need to find a place for it.
That's right. And so as you look at that commercial storage situation, Chris, what you're really doing there is speculating on a combination of an improvement in both futures prices and basis that would offset that potential cost, right?
That's correct. And again, many years we don't see, when we run this analysis, a 10, 20 cent a bushel loss from commercial storage. So this one actually, I think, is pretty encouraging to people who do not have on-farm storage to at least consider, if they want to speculate for higher prices, how do they do that? Stay with the cash storage at the grain elevator, or sell cash, buy futures, or buy call options.
Let's take a look at a futures chart. This is the December 17 chart through yesterday.
This is the nearby bid. Got a nice pointed arrow up since in August. On the other hand, this is a lot of corn. And can we get back to the top side of that that's more pushing up in the 390 range? I think probably not this fall. And I would draw a line at 360, basically a dime higher than where we are right now, and say that's, I think, about as much opportunity to the upside as we have this fall. So that tells us probably our opportunities for better prices are going to come on into the storage season. Jan, Feb, March, it may be some kind of weather disruption in South America. Generally, we'll get a week or two of too much water, too little water, La Nina talk, whatever that is. But again, we've got a lot of corn. We can't be thinking major price increases. We can be hoping for it, and we can be speculating maybe with smaller number of bushels. But I think we better be pretty realistic in trying to earn the storage and a little bit of maybe upside potential in terms of speculation.
Which means you've got to really pay attention to the marketing opportunities. If you see some bumps, take advantage of it, right?
Yeah, and what we said last year, when you have big inventories, as we had last year and we'll have this year, that after harvest, markets tend to get in a trading range. And that may be a 30-cent trading range on corn. And obviously, as you go through the winter time into the early spring, probably looking at defining that trading range. And then you do some more pricing at the high end of the range. You tend to hold a little stronger and not do pricing at the low end of the trading range. Again, that's pretty basic marketing, but that's, in a big inventory year, maybe what opportunities we have.
So let's just kind of wrap this up by summarizing our storage situation or prospects for corn.
Yeah, we basically said all of this. the carry is giving lots of incentive for on-farm storage. Normally, a storage hedge, harvest the grain, sell that July futures right away, have it hedged. Now, an alternative, those that don't want to use futures themselves, would be to work with their buyer. A hedge to arrive contract is the same thing, or sometimes they call them futures only contracts. But in that case, the position, whether the farmer sells July futures or the grain buyer sells July futures for the farmer's account, both have priced the futures, but they leave the basis unpriced, allow speculation on the basis to improve. Obviously, the advantage for most of our farmers on hedge to arrive is that the buyer pays the margin calls. This is a big deal, especially in these tight cash flow times for many farmers. I think an advantage of doing your own hedging is it's more flexible. Those who really understand these markets, they can decide to change position if they want, and it may be lower cost, especially if they're using online brokers. Those are pretty low transactions commissions cost to do the futures themselves. Now, I think the strategy at the bottom is what most farmers are going to do, and that is they're going to store unpriced rather than hedging right now with these really December futures. About 345 has been the low. We were at 349 last night, so we're probably at harvest lows basically. And that is to not price right now, get that grain in storage, hope to see maybe a 25 cent rally for some reason or other, maybe some talk of weather problems in South America, and then do your hedging out with your July futures and try to wrap up that 45 or so cents additional. 20 cents of speculation and then another 45 cents of carry. That gives you 65 cents. That's getting us up in the very high $3. So I think that's what a lot of farmers will do. But when you get ready to price, do look to see if that carry, those premiums on out for spring or summer delivery, will cover your storage cost. Get as much of that as you can get a positive return.
And I think that also implies if you're going to follow that strategy, Chris, you've got to watch that spread pretty closely.
Well, I think that's implied. That's exactly right. But our hope is to get towards the high threes, near $4 a bushel on corn. Again, we'd all like to have $4.50 or $5, but that doesn't seem realistic in this kind of a carryover year.
Yeah, because the challenge is if you remain unpriced through the winter, into the spring, and even in maybe the very beginning of summer, that premium that's built into those deferred futures is likely to erode pretty substantially.
That carry can erode, and we see this, and basically that kind of happened last year, especially through the winter and through the fall and winter. And that is the March corn, when it becomes the lead contract after December expires, it actually goes down by the time it expires in the May. We saw that on the March, on the May, and the July. So we saw that pretty consistently. The carry eroded and we lost the chance to earn that carry. This is a big incentive, and we'd suggest really understand how to capture that carry.
Yeah, so don't wait too long on that one, because that's exactly what I was thinking about from last year.
And if I could get a 20-cent rally on corn and get my 45-cent carry, I'm going to take some of that.
Yeah, so don't go to sleep on this one, is I think the message there. Let's switch gears a little bit and talk about soybeans. You've got the soybean yield chart up here, and again, a little bit like corn, we've been above trend for, what, 4 years in a row? 4 years
above trend, and fantastic yields last year, that 52 bushels. This year, USDA did lower by 0.4 of a bushel their yield here in October from September, 49.5 bushels, but still well above trend on soybeans. And obviously, this will start in the ag communities talking about, have we made some major breakthrough in soybean genetics, or is this just a weather event? We've just been blessed with great weather. It'll take time to sort that out, but again, at least closer to trend yields than what we've seen, but still good yields, and that is true as well as in much of the Midwest.
If you look at the production numbers, record soybean production. You mentioned this
Yeah,
earlier,
this was the acreage shift. So we did drop our production, our yield numbers on soybeans, but we had a lot more acres. So this gets us into trouble. Yes, we can use 4.3 billion bushels, but 4.4 plus, that's more than our usage base. So we're going to build carryovers pretty heavily. And again, just that statement alone is a little surprising to see a market that was up as much as near 30 cents a bushel yesterday. So again, I think we've got to be cautious here on beans. These inventories are going to be large. We're talking about on corn taking a 20-cent rally. Hey, you got a 30-cent rally in beans. Should we be taking some of that even today here? So we'll talk about that.
let's take a more detailed look at the balance sheet for not only the projected 17, but last year's as well.
Yeah, and again, start with 16, headed 16, 17. 16 crop, we mark it into 17. Go to the ending stocks number. That came out of the stocks inventory numbers done in September and dropped by 44 million bushels. So down to 300 million. So that was fairly significant right there. And what it essentially said was that USDA needed to make some adjustments in use or production. So if you go up then to the production number, they dropped production from the 16 crop by 11 million bushels. And they increased, put most of the usage in residual. Residual just simply says the numbers, we're trying to make them work out. We don't know what's causing it. The seed number we know, but the residual is just fudge numbers, basically. So most of it went right there. But the good news from our price standpoint was lower inventory of finishing the 16 crop meant a lower carry-in coming into 2017. And while they did lower the yield a little bit, they increased acreage, so production really didn't change much. And essentially all we had for the 17 crop was that the ending stocks went down by 45 million bushels. That was driven by the carry-in adjustments from the 16 crop. So that's basically what I anticipated was going to happen. So I was kind of surprised to see the market be so joyous that soybean bulls are back in the marketplace. So again, you can see USDA, they continued with their $9.20 price for this 17 crop. And we've got opportunities $9.50, $9.60, $9.70 to sell beans right now. And I think that's always something we want to look at. USDA, they're going to be off at times. They're trying to make predictions of the future like all of us, and the future is very uncertain. But you look at their price range, $8.35 a bushel to $10.05 is the range they had. And when we've got a chance to sell beans over $10 a bushel today for next summer delivery, that's something I always think about. When you can sell at the high end of the USDA price range, that's something that you can't just dismiss. You should be thinking about that. So those are, market is clearly saying beans are not going to be $9.20. Beans are going to be $9.70 or $9.80 a bushel. And I think you have to be very cautious with a carryout of 430 million bushels of saying beans are going to be $10 rather than closer to $9 as USDA. So obviously, I don't mind doing some pricing on beans if we can carry through today with the prices we saw yesterday.
Chris, one other point on the balance sheet that I think is a little different than what we saw in corn. You really stressed the weakness, expected weakness in corn exports. On the soybean side, USDA is projecting exports to be the same or maybe a little bit stronger than they were last year, and certainly stronger than the last several years prior.
And if you talk about soybeans, sometimes they're regarded as the miracle crop. And we talk, multiple years we've talked about, the carryovers are going to be so big. And when we got to the end of the year, carryovers weren't as big as they had anticipated. So the miracle crop, it seems like soybeans find a usage base. Now that usage base is clearly driven by China, but we expect that to be positive. And I think that's built into the price now. in the futures market, that 430, that could drop under 400, but still we're 300 last year. This is a major increase, even if we drop that to 400 million bushels. Again, I think we've got chance to get soybeans in the 1025, 1050. That's the kind of prices we'd like to see producers be able to get, with a combination of a little speculation and then earning the carry we'll talk about here in a second.
Let's look at the seasonal price pattern for beans the way we looked at it for corn.
Yeah, run the same numbers on soybeans. I was using a 950 price, and that gets us up in that 1030, 1040 price, 1050 price. I think that's pretty realistic. On the other hand, our bids here in October are more 950, 960, 970, depending on your location. And again, this pattern probably won't be quite like this, but I still think something over the $10 mark up to 1050 would be possible as we go into next spring and summer.
Let's look at the cash price pattern.
So again, well, let's just look at 16, the green line. Remember, the red dots are this year. The green line is last year, and you can't see the green line on the left-hand side in Sep and October because it's covered up by this year. Fairly similar prices in the low to mid 950s. Then on soybeans, as most of us remember, we did get cash bids at this central Indiana location on the green line to 10, and in some of those weeks above $10 a bushel, pushing up near 10 and 50 in January and February. That seems fairly realistic. The numbers I talked about, 1025, 1050 cash prices at some point this year. And again, with a bigger carryout, one would anticipate would probably be somewhat lower on prices. Right now, we're tracking pretty much on that. So I think that is a realistic kind of expectation to have based upon last year's price pattern. And a little more optimism, I think, overall in the futures market. And I think that optimism is driven by expectations now that U.S. yields are at least closer to normal. South American yields probably will be closer to normal, and that is going to, and Chinese demand will remain strong.
Let's take a look at futures and actually that spread.
Here
right?
we go on the soybeans as well. That spread was about, and we're looking at the July next summer futures versus our harvest November futures, about 20 cents a bushel, but it's almost doubling, spreading out to near 40 cents. So big incentives on the futures market. We see the good crop in the United States. Somebody has to be given incentive to store this crop, and that incentive has stretched out in the futures component to 38 cents currently.
So that creates some opportunities.
There's opportunity, and this is unusual in beans to see this much opportunity. So we're going to run the same numbers on soybeans as we did on corn. These were the closes as of yesterday afternoon. November futures were $9.92. Go out to the July 1030, that's at 38 cents a premium in the futures. Basis a little bit weaker generally on beans at this location, but I've got the basis appreciation at about 17 cents as well. So the total carry, futures, and anticipated basis gain, 55 cents a bushel. Subtract some cost for on-farm storage. I've got that listed as interest. The first 3 cents under November, that's for insurance, and then I've got 3 cents a month of interest cost after that. Let's go over to the right-hand side. Well, June is the optimum. We've got an anticipated gain of 53 cents a bushel in soybean price with 24 cents of on-farm storage cost, 29 cent positive return for on-farm storage. Now again, we were 35, 36 cents on corn. Not as good as corn, but often when you run this analysis, it shows no return at all for on-farm bean storage or negative return. So we've got the incentive to both store corn and incentive to store soybeans. So find all those little nooks and crannies you can around the farm. I know some that even use machine sheds at times to add to their storage. That's higher cost labor, but maybe they have that labor in the winter time, late winter, early spring, when they can move that corn even out of a flat storage, machine sheds type of storage. Now, commercial storage, pretty bigger losses. Let's go out to April, May. I'll just take May as an example. We got 24 cents positive storage return on farm, but we'd have to pay 33 cents commercial storage. So now we're looking at 8 to 10 cents negative expected return for commercial storage. I'm probably, if I want to speculate, sell cash, buy a futures, or buy call options.
So I don't know about you, Chris, but when I look at the soybean storage situation and think about the corn storage situation, I'd be more inclined to sell July futures in soybeans to lock in that storage return than I probably would be on the corn side. Do you agree?
Well, yeah, and let's look at this chart on the cash. That's the third row of numbers down. And we've got, with the 10/30 July futures at 1,300 basis, 10.17 price expected. Now again, I don't think many buyers would be bidding quite that much yet. I'm willing to speculate the basis will get better. But I'd be looking at those bids for next July right now. And
those
that could
pretty
be
attractive,
late
don't
May,
they?
June, or July.
Yeah,
now.
Those look pretty attractive.
And again, we're talking about maybe if we could speculate, get another 30 cents up on beans, weather scare in South America, and then get 50 cents of carry in the market as we're talking about. That'd be 80 cents better than our 960. So that would take us up around 1040. So that's that 1025 to 1050 I'm saying that's our objective. But hey, if I can right now get something that I'm thinking is up 1015, 1020, I would certainly consider selling some beans right now and earning this carry with on-farm storage.
That'd be my recommendation as well.
Sell
some
of the beans. Get started adding some.
Exactly.
Adding some.
Don't wait with all of your remaining unsold or unpriced beans. So.
Yeah. Now, soybeans do have a bit more positive upside in terms of the overall price pattern. This is the November futures. We also had a big turnaround day yesterday in the sense that the market traded lower, traded much higher, and closed much higher. That's a pretty bullish signal for technicians, but this shows the close yesterday, 992 on November beans, with the top side objective back up around 1020. So that's that other 25 cents of recovery that we maybe have an opportunity to retouch that 1020. There adds another 20, 25 cents of speculation and the 50, 55 cents of carry. That gets us up in the 1030, 1040 range. To me, that is as much as we can expect right now, unless there's weather problems in South America, which is always a possibility.
Okay.
That's just a restatement. Same strategies on corn. If you got those on corn, use them on beans as well. And then I wanted to talk a little bit going into the future, just a little bit more. These are U.S. average farm prices. FSA now calls them marketing year averages, and those are used in calculations of our government program payments. But these go back to 2012. Why? That was the record high price year for farm prices. Corn near $7 a bushel. The yellow background highlights the lowest of those prices, and that's right now. This 17 crop, 320, that's what USDA is using. Now for 18, 19, and 20, I go out and look at futures prices and then do my best estimate of what does that mean, what do those futures prices mean to a marketing year average price, U.S. farm price. Much better in 18, 19, and continuing to improve on corn into 20. So the shifting, I think, in acreage will continue to be a little heavier to beans. We expect that in South America, a little less corn acreage. It's going to improve corn overall. Beans, not a lot of improvement, but we've got 920 this year USDA is talking about, and 975 or so obviously is 50 cents better, a little bit better on beans, and wheat getting better by the time we get out to 1920. Now again, we can't say this will happen. This is futures anticipation, but to me it's giving us some hope that we could push revenues up a little bit, especially as we get into the 18, 19 crops. We get through these big carryovers this year, maybe a little bit of improvement. It's not going to get us back to $6 corn, but $4 corn is sure a lot better than this low threes that we'd seen.
And I think the next slide is going to talk a little bit about cost of production.
Yeah,
So it's
yeah.
time to start
So
thinking
it's
about
not just revenues, but if we can push revenues up some and work on these costs, that's going to be really important.
And if you get some opportunities to lock in some prices that are at or maybe slightly above your break even, that's probably a good signal to actually start marketing that particular year's crop, right?
Absolutely.
So let's take a look at that. These are based on the Purdue crop budgets that are prepared by our colleague, Michael Langemeyer. And we wanted to take a look at this, Chris, because we wanted to look at the change in cost over time. So these are estimated production costs for a corn-soybean rotation. And we're just looking at some of the key costs here. So we've just isolated fertilizer, seed, pesticides, and cash rental cost. And as you look at that chart, starting at about 2013, you can see how those costs per bushel have started to come down. So a lot of talk in the industry about difficult to make cost adjustments, but we have seen some changes take place. Part of that's come out of a gradual reduction in cash rent, and we're projecting another modest decline in cash rent for 2018. A good chunk of that's coming out of declines in fertilizer prices, especially nitrogen. Chris, we were looking at nitrogen prices based on the USDA's Illinois production cost report this morning that USDA released yesterday. I think anhydrous ammonia was priced at just above, the midpoint of the price range was just above 400. The low point was actually
nearly $100 higher a year ago in the fall.
Yeah, so we're seeing some significant reductions, not so much on, particularly compared to a year ago, on potash and phosphate, but definitely on nitrogen. So that's starting to give us some help. Not so much on the pesticide side, and that will be especially true when we look at the bean chart, but we are seeing some reductions there. In fact, when we look at it, including all of our costs, so this chart looks at it with variable cost in blue, the overhead charges, which includes cash rent and machinery cost, et cetera, and then compares that to gross revenue. You kind of see what the changes taking place there. When on a per bushel basis, 2013, we were very close to $5 a bushel. On 17, 18, we're now getting down closer to $4 a bushel. This is on the average productivity soils here in Indiana. If we look at the high productivity soils where the yields are higher, we actually start to pull those production costs down even a little bit more. So we are seeing some changes there, but it kind of points out though, when you get a chance to lock in those prices on those deferred futures that are close to your break-evens, you probably ought to be looking at that as a pricing opportunity to at least start pricing those future crops. Do you agree, Chris?
Oh, I think so. And again, we can think about this last year where you have relatively narrow ranges. This is in price patterns. That's what you tend to get with big inventories. And those ranges may become fairly definable. Looking at $4 Dees corn futures for this December. This year, we had 5 opportunities to sell December corn above $4 a bushel. And again, looking back on that, we'd say, well, how did we miss that? You know, that was so consistent. We'd rally to 410 and then go back down again. So those are the kind of opportunities I think we have to take advantage of in these kind of years. Now, hopefully, we'll have years where we get our inventories in more manageable volumes, and we'll have more of the dollar increase opportunities in corn and the multiple dollar increase in soybeans. But right now, I think we have to be more conservative, and we have to keep chipping away at that cost. Another cost factor is the cost per bushel, is keeping our yield productivity high. If we can increase that a little bit each year, that helps bring, if we can hold our our cost per acre the same, that'll bring our cost per bushel down a little bit. So it's all a matter of doing everything in the farm business and the farm family to try to bring revenues up a little bit and costs down some.
Let's look at the same kind of analysis on the soybean side. So again, we're looking at some of the key costs, fertilizer, seed, pesticides, and cash rent for soybeans, again on average productivity soils here in Indiana. And the chart looks different, right? As you look at some of those peak production costs in 12 and 13, we started seeing some reductions showing up, but here the last 2 years it started going a little bit the other way, and a big chunk of that is on the pesticide arena. And Chris, we were talking about it earlier. that's really being driven by the increased cost of managing resistant weeds, right? That's really changed the dynamics of how we manage a soybean crop here in the Midwest and particularly in Indiana, as we've had to look at alternative strategies to try and hold down the problems associated with those resistant weeds, and that's meant a change in our herbicide program, which on a per acre basis is driving up costs, but it's a necessary cost.
Yeah, and essentially these are budgets that Michael has put together, but as he works with farmers, he looks at actual cost data that comes off of farm data like the Illinois farm records, and what he's seen is that farmers are having to battle the weed problem in soybeans, and basically that has increased the cost. Just more chemical, more times over the field, and that's what's really getting reflected in 17 and 18. Is he's changed that budget using multiple herbicides instead of a single herbicide, right, et cetera, more times over the field.
So when you look at the variable cost, overhead cost versus gross revenue, the picture looks a little different than what we were showing for corn. As you look at that combination of variable cost and overhead cost on a per bushel basis, we're actually looking at production costs that are a little bit higher than they were back in 12 and 13. Still down maybe a touch from where we were in 15, but we're struggling to reduce production cost on a per bushel basis in soybeans based on those average yield numbers. Now, admittedly, as we visit with farmers, if you're in a high productivity situation, and we've heard of some very strong soybean yields in various locations here in Indiana, that does reduce those production costs per bushel quite a bit. So that's a factor to keep in mind. But when you look at average productivity, and these budgets are using productivity on 17 and 18 in the low 50s, that suggests we've got some challenges. And again, if you look at those break-evens, you get an opportunity to lock in prices that are at or above your break-even, a little bit like we talked about in corn. Probably need to be doing that, at least using that as a starting point for pricing that future production.
And on the cost side, beans, I think are being driven by P and K, have not gone down as much as nitrogen. That favors lower corn cost. And then the chemical cost on soybeans, trying to control those weeds, which we used to be able to do very easily, and that's not easy anymore.
Yeah, it takes a lot more management and more inputs.
That's right.
Well, that kind of wraps it up, Chris. Of course, this webinar will be available for viewing on our website here shortly. We'll also have a copy of these slides. If people want to download a copy of the slides, they can do that and maybe study them in a little more detail. I wanted to mention we've got some upcoming webinars. The Ag Economy Barometer webinar will take place on November 9th. And then we've got our annual Ag Business Climate Outlook taking place on January 5th. And right after that, Chris, is when we have the Top Farmer Workshop here in
that's
West
a new
Lafayette.
Not a new location, but a new time.
Same location. It'll be at the Beck Ag Center here in West Lafayette, but that'll take place on Tuesday, January 9th, with a pre-conference scheduled for the afternoon of Monday, January 8th. Great. So we'll have more information about that on our website, but keep your eye out for that, and we're looking forward to having the Top Farmer Conference here in January.
A little different time of year, and it's really driven by farmers, right? Telling you that winter's better time than summer for them.
Yeah, we did some survey work with farmers, and that suggested that we should move the conference from the summertime to the winter, so we're going to try that this year, and looking forward to doing that here. We'll have some more details about the content. We've actually just finished up putting the program together here, and we'll have that on the web shortly. So with that, thanks for joining us today. On behalf of Purdue Center for Commercial Agriculture, I want to wish you a good day.